Are you here to improve your investment strategies? Are you looking for that one article that could help you finalize that decision you were holding off? Well then, get ready to learn more and gain just that subtle extra knowledge to get an edge in the investment business. Because if you're new here, then you've come to the right place. Welcome to The Daily Fortune, a channel where we talk about all the latest news, updates, guides, and strategies related to investment. Of course, with that said, we're going to be discussing a lot about the Oracle of Omaha, Warren Buffett, The Big Short, Michael Burry, the money tree Cathie Woods, Tesla's very own CEO and eccentric billionaire Elon Musk, along with the rest of the big leagues to learn just a bit more from the professionals. And don't worry, of course we talk about crypto, and we also talk about the best stocks to invest in, along with many tips and tricks on how to handle your finances so you never lose. So before we talk about making money, remember to hit that like button, subscribe, and ring that notification bell as well to make sure you won't miss a single video. Now let's get started. In this video, I'm going to discuss how Warren Buffett evaluates a stock's intrinsic value. So what are we trying to do with valuation? Some people think of a company as a machine that prints money every year. We need to find out how much we should pay for the money printing machine now in order to earn a decent return on investment in the future when it prints money. By using this concept, we can look at the company as a whole and then calculate how much we'd pay to purchase it all, assuming it generates X amount of revenue each year. After determining how much we'd be willing to pay for the business, we can compare its intrinsic value to its present market capitalization. For those who may not know, a company's market cap is its overall stock market value. Basically, it's equal to the number of shares the business has divided up into, multiplied by the current share price. If the market capitalization exceeds our intrinsic value, the business is overvalued. However, if the market capitalization falls below our intrinsic value, it's a good indication because it means that the business is undervalued. That's what we're attempting to do. And I'm also going to include what Warren Buffett shared about the process of getting intrinsic value.
Is how do you find intrinsic value in a company?
Well, intrinsic value is the number that if you were all-knowing about the future and could predict all the cash that a business would give you between now and Judgment Day, discounted at the proper discount rate, that number is what the intrinsic value of a business is. In other words, the only reason for making an investment and laying out money now is to get more money later on, right? That's what investing is all about. Now, when you look at a stock, when you look at a bond, assuming it's the United States government bond, it's very easy to tell how much you're going to get back. It says it right on the bond. It says when you get the interest payments, it says when you get the principal. So it's very easy to figure out the value of a bond. It can change tomorrow if interest rates change, but the cash flows are printed on the bond. The cash flows aren't printed on a stock certificate. That's the job of the analyst, is to print out, change that stock certificate, which represents an interest in the business, and change that into a bond and say, this is what I think it's going to pay out in the future. When we buy, some new machine for Shaw to make carpet, that's what we're thinking about, obviously, and you all learn that in business school. But it's the same thing for a big business. If you buy Coca-Cola today, the company is selling for about $110 to $15 billion in the market. The question is, if you had 110 or 15 billion, you wouldn't be listening to me, but I'd be listening to you incidentally. But the question is, would you lay it out today to get what the Coca-Cola company is going to deliver to you over the next 200 or 300 years? The discount rate doesn't make much difference as you get further out. And that is a question of how much cash they're going to give you. It isn't a question of, it isn't a question about how many analysts are going to recommend it or what the volume in the stock is or what the chart looks like or anything. It's a question of how much cash it's going to give you. That's the only reason. It's true if you're buying a farm. It's true if you're buying an apartment house. Any financial asset. Oil in the ground, you're laying out cash now to get more cash back later on. And the question is how much are you going to get, when are you going to get it, and how sure are you? And when I calculate intrinsic value of a business, when we buy businesses, and whether we're buying all of a business or a little piece of a business, I always think we're buying the whole business because that's my approach to it. I look at it and say, what will come out of this business and when? And what you really like, of course, is them to be able to use the money they earn and earn higher returns on it as you go along. I mean, Berkshire has never distributed anything to its shareholders, but its ability to distribute goes up as the value of the businesses we own increases. We can compound it internally, but the real question is, Berkshire selling for, we'll say, 105 or so billion now. What can we distribute from that 100? If you're going to buy the whole company for 105 billion now, can we distribute enough cash to you soon enough to make it sensible at present interest rates to lay out that cash now? And that's what it gets down to. And if you can't answer that question, you can't buy the stock.
So let's start with how to find the intrinsic value in a company. Can your business generate enough revenue for you quickly to make it a sensible investment if it sells for a market cap of 105 billion? The method we'll use to figure it out is known as discounted cash flow analysis. The long way of expressing it, as Warren Buffett puts it, is the discounted present value of all future cash flows. Figure out how much it is to buy the business right now, then we'll keep it for 10 years before selling it. So there, we'll have to put some money down now to buy it, and then we'll get 10 years of great profit from the business operations. And then we'll get a big one-time payment when we sell it in 10 years. So how much are we going to pay for it now? Here's the first step. Calculate how much cash this money printing machine generates for its owner each year. This is known as free cash flow. So the company generates money and spends money, and the free cash flow is what the owners of the company can possibly keep each year. This value is calculated from two numbers on the cash flow statement. It's the cash flow from operations minus the capital expenditure, often known as the purchase of property, plant, and equipment. So if you want an accurate result, we'd like to remove the portion of the capital expenditure that's tied to growth and expansion. It would be just the cash flow from operations less the capital expenditure required for just maintenance. However, firms don't usually provide this information, so you'll have to calculate it on your own. For this example, we'll utilize free cash flow. Free cash flow is a better option. It's more conservative, but it is slightly less precise. So now that we know the cash flow of the business, the next step is to determine how well they'll be able to expand their cash flow each year for the following 10 years. This growth rate is up to you to find out, and it will vary for each company. So just remember that the growth rate you choose will have a significant impact on the outcome of your intrinsic value computations. So don't get carried away while estimating how much this business will expand over the next 10 years. Don't mislead yourself into thinking they'll expand at the rate of 200% per year for the next 10 years. Even a 25% growth per year is a very high rate to use. So generally, there are a few methods to keep grounded. First, look at the 10 years of free cash flow and equity growth to see how quickly they've increased on average. Second, find out the industry's normal growth rate, so you know what other companies in the same industry have achieved. And the third step is to truly understand your company's future growth drivers and how they will likely affect cash flow. For example, Tesla currently has 2 new factories that will come online over the next 5 years. And in fact, by next year, they'll be ramping up. So how will those factories affect vehicle deliveries, and what will that imply for Tesla's free cash flow given their existing margins? Essentially, there's a lot to consider, but these 3 guidelines should guide you in determining an annual growth rate for your company. Let's use a growth rate of 10% each year as an example. So for the following 10 years, let's boost the free cash flow by 10% per year. Simply multiply the previous year's free cash flow by 1.1, and then we're going to sell. For the sake of this calculation, we're assuming we'll sell the business in 10 years. This is what we call terminal value. So how much can we sell it for? Let's take a look at what multiple free cash flow the company has sold over the last 5 years. If we look at the average and say we could definitely sell the business for that free cash flow multiple in 10 years, then 25.5 is certainly a high multiple for this business. So you'll have to assess it a little bit more. But for this example, let's go with 25.5. To obtain our terminal value, we need to multiply the 10th year of free cash flow by our free cash flow multiple. We now have a complete computation of our future cash flows. But keep in mind that this method is about calculating the total of all discounted future cash flows. So what's the big deal? Buffett famously stated, "Can the business deliver the cash to you soon enough to justify buying the business at its current price?" This time aspect is critical since the value of $1 today is worth more than the value of $1 in the next 5 years or so. And we don't have to wait that long. If we had that $1 right now, we could invest it and turn it into maybe $2 or $3 by the end of 5 years. So you always have to consider the opportunity costs. Therefore, if we want to achieve 15% annual returns in our stock portfolio, all we have to do is discount future cash flows by 15% per year, and as you get further, even though the company is growing its cash flows at 10%, the present value of that future cash flow is actually decreasing year by year due to the opportunity cost. Buffett remarked that the further out in time you go, the less consequential it is to your intrinsic value. However, we've discounted the next 10 years of cash flows at a rate of 15% per year. Don't forget that in the 10th year, we also discount the terminal value. So we've just computed how much we'd pay now for the annual future cash flows that we will receive from owning the business, as well as how much the big one-time check from selling the business is in 10 years. Just simply add all of the discounted future cash flows together to find the current intrinsic value of the business. If the business grows its cash flows at a rate of 10% per year, you can sell it in 10 years for 25.5 times free cash flow if you wish to earn 15% per year. In this case, $595.97 billion. There you have it. The discounted cash flow model is the sum of discounted future cash flows. If the market cap is less than the intrinsic value, it means we could purchase the business at its current stock market value and expect to generate 15% annual returns. But there is this important final step to do. We must add a margin of safety to our intrinsic value because everything we've just done is technically attempting to predict the future. The future is unpredictable. We can't foresee it with 100% precision. Therefore, we're going to be wrong on some parts. And as a result, we add a margin of safety to our intrinsic value, perhaps 20, 30, or 50% depending on your preference. However, if you can get the business for significantly less than its intrinsic value, you should do so because it de-risks your investments and protects you if the future does not turn out the way we predicted. However, if your future predictions are fairly accurate, the margin of safety will allow you to attain a larger rate of return than your projected 15% every year. So the overall margin of safety is crucial. And there you have it. That's how Warren Buffett determines a company's intrinsic value. And of course, you can do it as well. I hope you learned something from this video. Thank you for watching. So that's it for today. I hope you learned something from today's video. And to get updated with the next videos, don't forget to hit the notification bell. See you next time.